by all means, sit in front of a screen all day if you want to. You have to develop a criteria for entry and exit. And unless unless the trade fits that criteria and you have that discipline, then you have to have the self-control not to trade impulsively. It's so important.
There's a lot of hard work that needs to be put in because you can go to college, you can graduate from high school, you can get a job and make some money. Then you can go to university, get a bachelor's degree, you can make a little bit more money. You can go get a master's, make a little bit more money. A PhD, a lot more money. But then in Forex, there's no such thing as if I learn a little bit more, I'll make a little bit more money. Yeah. It's either you make money or you don't. It's basically you go straight PhD or you don't. Like, you don't make any money at all. So there is no, if I learn a little bit, I'll make a little bit of money. There's no such thing as that. It's either you make it or you don't.
It's all about the discipline. You can be the best technical analyst in the world, but unless you've got control of your discipline and your risk management and your trade management and your account management, forget it. One of the questions I got asked was, if Steve Neeson is such a great technical analyst, how come he's not, the richest trader in the world? And I don't know how rich Steve Neeson is. I'm sure he made so much money he doesn't even need to trade. But he's clearly very, very good. I mean, I read a lot of his books. But my answer was that it's not about being the best technical analyst. It's really about controlling your own emotions and your risk management.
My first phase was, I don't know what I'm doing. As much as I'm doing it, I don't know what I'm doing. So it's like, even if I'm sitting here 20 hours a day, if I don't know what I'm supposed to do, then I'm just wasting time. Right? It's like going to the gym and you practice the wrong way. It's actually going to be harmful than than beneficial. But so I was putting in a lot of hours. My mental capacity thinking, if I put in a lot of hours, I'll get the benefit from it. But you can't do it if you're doing it the wrong way. Obviously there's not one single right way, there's multiple ways, but I kept putting in the hours, doing the research, looking for techniques and strategies, what works best and basically what can I do that will always make money and never lose. So that was my mental state at that point when I started. Then came to phase 2 when I did have an idea of what I need to do. Then stage 2 was the psychological barrier of, can you do this regularly? Can you do this frequently? Can you do this bigger? Right? Because that's the next stage. Is like, okay, if you understand how the markets work, then why are you trading one mini lot? Step up your game. Show me. That part was hard for me because as in university, I had not much money to myself and every penny counted. So every time I made a loss, I actually felt it. Like, that meant that's my rent or that's my food. And, so I really felt it. So that psychological barrier is like the next phase that you have to overcome.
While my technical analysis may have been good enough, my psychology was not nearly where it needed to be in order to be able to be consistent. And I think part of being consistent in trading, when you first say that to a new trader, that tells them in their brain that they're going to make money every day. But being consistent as a day trader does not mean you are going to make money every day or every month or even every year. Being consistent means you show up, you follow your rules, even when you're in the down periods. And that took me a long time to understand, because every time I'd get into a period of drawdown or take consecutive losses, I'd be pissed at myself and I would end up just taking it out on the market. So that self-sabotage set up tons of hurdles for me. But I think other than the psychology side, the technical side, I felt like I had a good grasp on, because a lot, if not 90% of the courses that I watched were all technical analysis. I've done a lot of mindfulness work, which the mindfulness work outside of trading, I think has transformed into beneficial characteristics that show in my trading, increasing my patience, increasing my discipline, pushing myself outside of my trading to be my best self. Because I'm sure you'll agree with me on this, your trading self is a direct reflection of your everyday self. So if you're out in the world and the characteristics that you exhibit do not align with successful trading, there's no way you're going to be able to come in and trade well. But if you can align yourself off the charts with the good behavior that you need to be good on the charts, I think that's where you find the sweet spot.
In the beginning, the mindset is only focused on opportunity. You're only looking for, where can I make money? Where can I make money? Instead of, which is much later as an experienced trader, your objective is, where can I not lose money? See, this two differences, one is trying to protect your money, the other one's trying to say, where can I make money? The where can I make money attitude actually gets you into every trade, good ones and bad ones. And the bad ones, because of psychology in the beginning, will overrule the good ones. So your losing trades will become bigger than your winning trades. And that cycle is very dangerous. So getting to that point where you need to realize you got to protect your money instead of, make the money, or looking for opportunities time and time again, there needs to be a shift in thinking.
Keep the indicators to a minimum and just look at the time frames. And like you said to me earlier, when everything lines up, if the weekly chart, the daily chart, and the 4-hour chart kind of all line up, and they're all in the same trend, and they're all showing that, say some of the moving averages are lining up in the different time periods, something like that, that gives you a lot of confidence in the trade.
There's levels of trade, right? So there is the preparation phase, which is very, very important. You can't skip that. If you feel you're in a trade and you don't know what to do next, preparation has failed. You got to go back to that. It's not how you do the trade. It's preparation. It's failing there. So you got to master the preparation phase. Then if you know what trades you have to take because you take the trade, but then the trade runs away without you, then it's the second phase, which is you gotta master your entries. How do you time it to get it just right? Then the next phase is, once I master the entries, my profits are still low, but my losses are high, but my entries are good. Then you have to master trade management. How do I learn to stay in the trade and stay with the trade as long as the trade allows me to stay in it with it, rather than panicking and saying, but this is where I should exit, or this is my stop loss. I made enough money, look at the dollar amount and close, That part you have to control. And then the fourth phase is obviously recapping the whole thing and saying, can I remember this to do it all over again if I see it again? So these 4 phases are equally important, and not one should be overlooked.
From birth onward, we develop coping strategies, coping styles. Sometimes in psychology, we call it defense mechanisms, way to kind of protect our ego, protect ourselves from difficult situations. And when we develop strategies, whether the strategy is to retreat or to yell or to whatever it is, we have these defense mechanisms, all kinds of them. And they're attempts to survive and get through the situation. And, as we get older, what happens is we tend to keep those same strategies, and then we bring them with us into our trading. They might look a little different, but it's really the same thing happening. And so it's learning about what are my more adaptive and what are my more maladaptive coping strategies, and how can I have more adaptive ones for my trading and drop the ones that are more maladaptive that I had long ago. Classic example, it doesn't even come from childhood, would be, the person who grows up really good at math and logic and becomes a programmer, and it's like they go to trading, and oftentimes, not always, but those people tend to be a little bit more on the risk averse side, but not always. I see some of them can be crazy risk seekers too, but they tend to be a little bit more, things have to be just right, just lined up just right in order to be in the trade and for the trade to keep working for them. So that's an example of learning about, anything that's not black or white. There's a problem and I need to avoid that problem. That's a maladaptive coping strategy right there. The other big one, besides the coping strategies, is how one responds to and experiences authority figures. That's the other real big one. The market is an authority figure for all of us traders, regardless of how big you are. I worked with traders who are the biggest trader in their own market, and they still get pushed around and have problems. The market giveth and taketh away. You can't tell the market what to do. That means the market is the ultimate authority figure for us traders. Our first earliest experiences of authority creates a template for how we're going to feel about authority, experience authority, and react to authority. Very often when I get to know a trader really well, it takes more than a few sessions. I need to really get in there and learn a lot about them, their background, what they're doing now, and how they grew up. 90% of the time, I'm able to find, and the client is able to see with me when I show that to them, how they are experiencing the market so similarly as they experienced some type of an authoritarian dynamic earlier in their life. It's really interesting.